Hello everyone, welcome to this lecture on economics of public policy. In our last lecture, we introduced different indicators or components that are used in microeconomics and macroeconomics. Understanding and calculating for national output, there are two approaches primarily. One is income approach, the other one is expenditure approach. So income approach measuring GDP, and here GDP we refer as output by summing the income that farms pay households for the resources to produce the goods and services. So it's basically farm level data that we get it, that those farms who actually in return as factor of payment. And in our last lecture we already had shown the circular flow of two basic units, which are households and farms. And as you know that households, they supply factors of production, and here factors of productions are land, labor and capital, and in return factors of payment that farms pay to households. And here if we look at the income, like say wage is the income for labor. So it is basically the total compensations towards the labor that are used in order to produce goods and services by the farms. Then for capital, we pay rate of interest. Farms will pay rate of interest to the financial institutions like banks if they borrow money from a bank, and rent for the land, like three basic fundamental factors of productions. So for rent is the rental income that will be counted as part of the income approach of GDP calculations. So now the fourth component that we did not mention in our last lecture, we briefly spoke about it, about the entrepreneurs or the organizations. So for our entrepreneurs is the profit. So here in case of income calculations, corporate profits and proprietors income will be taken into account while calculating total national output, and here is GDP. So this is a income approach which we follow when we calculate GDP, if economy is considering income approach for GDP calculations. So here we already introduced this in our last class. These two equations like 1 and 1a, already if we follow expenditure approach, and then here in case of closed economy we already discussed like y equals to c plus I plus g, and then y equals to c plus s plus t. So even in this case, if we follow income approach, so this is also good way to understand. And in case of open economy, here y is the national output, will be equals to c plus I plus g plus x minus m, and here x is export and m is import, and x minus m is a net export. So now if we follow expenditure approach, so here in this course will be I'll be taking expenditure approach to tell you what are the macroeconomic elements or the components that are used for policy calculations. So now C is consumption expenditure, that we know is the flow of expenditure related to purchase of goods and services. So it basically comes from the households. So for household consumption expenditure equation is important. So how we write? So C is capital C equals to capital C naught plus small c and yd. So what is C naught? C naught is autonomous consumption, and small c is a marginal propensity to consume, and then broadly capital C like total consumption expenditure, is a function to total disposable income, right? So here total disposable income, what does that mean? So total disposable income is like net income after deducting the total tax on the total income. So one can also imagine from individual's perspective, like if you consider one consumer or one user, and for that consumption for that particular individuals will be depending on the disposable income of that particular person. So even for direct taxes that a person pays, so after deducting the tax is basically the net income that individual will receive, it will be called as disposable income. In case of national consumption is basically total tax on the national income. If you deduct that from the gross income, you will get the disposable income. And then C is the total consumption is proportionately related to disposable income. So this is we are trying to break all the broad indicators from the grand macroeconomic equations. So now for the savings, so another one important concept in our national output equations, and here saving is the flow, as we already explained in our previous lecture. The difference between flow and stock, and saving is the flow of the income withheld from consumption to increase. So savings is proportionately related to total income. And then small s, here small s is the saving rate, like at what rate that a person or the nation is saving from the total national output. So of course savings is a leftover, as we know, after the consumptions, and therefore savings is actually disposable income after paying the taxes. And then you also have to deduct total consumptions. So small s is very important here, and small c is very important here. Small s is the saving rates, one can also call it marginal propensity to save, and small c one can call it marginal propensity to consume, like what is the total tendency or the propensity to consume from the total output. And savings likewise, marginal propensity to save is the total rate of savings from total level of output. So here if we consider this, then one can also write this expression can be written as capital A is equals to y minus t minus c. So this also can be written. So now next move to the third component, important component. If we consider investment is expenditure. So investment expenditure is a change in the capital stock, and here from savings function we got it like S, capital S equals to disposable income minus consumptions. And as we all know, like equilibrium conditions is like savings should be equals to investment, means whatever savings that households they will save in the financial institutions, and that needs to be invested. So this investment expenditure is done by the farm. So this is the equilibrium conditions, like equation 6 is the equilibrium conditions. So even if we see this way, if this is savings and then this is investment, and then this is the equilibrium where savings will be equals to investment, right? So this is how this equilibrium conditions in the macroeconomics, this assumption is very important to remember. So now G stands for government purchase of goods and services, and that is gross. And then T, which is very important, T is equal to the taxes paid to the government less the transfer payments received from the government less interest payment made by the government on its debt or loan. So if you recollect our circular flow in our previous lecture, you will find that we put the government and also financial institutions between farms and households, and we know that how government intervene um, in the farm, and also how government is connected to the households. So households will pay the taxes, both direct taxes and indirect taxes. Through distributive and redistributive policies, government will return, like transfer payment through transfer payments or wages for the work, public work. So in return they will pay to the households, and in case of farm, government will pay actually different subsidies, and farms like corporate, they will pay the taxes to the government. That's how government generate revenue. On the other hand, there is a relationship between government and bank as well. Like bank also borrow money, like take loan, and in return uh, government also needs to pay rate of interest. So here the taxes that we are talking about, we'll just discuss in details. So capital T is a total gross tax, like total revenue that is collected through the tax. And then total, I mean T, capital T small tp is like transfer payment, like from the total tax, the revenue that government will generate through the tax. And after getting the revenue, then government needs to pay, government also needs to pay the transfer payment, like not pay in terms of like payment, like benefits, like through regulatory through distributive and redistributive policies, for example unemployment benefits, or other social assistance programs, and government rate of interest that needs to be paid to the bank. And that's how we get the net taxes, net taxes, which is very important for the fiscal policies. And this particular discussion will also discuss when we talk about macroeconomics and public policy in general. And here capital G is our government purchase of goods and services, or expenditures, like if government decides to build roads or bridges or other physical infrastructure or social infrastructure like schools and hospitals, then those are counted as government spending in the economy, and which will be counted as part of the expenditure. And that's why C plus I plus G is basically expenditure from the government that we consider. So now let's move to two important concepts in economics. Is like we always try to find out the optimization conditions, so equilibrium points that we try to look. And here there are two ways that one can understand economic efficiency and also the equilibrium conditions. So here the partial equilibrium, let's begin with that first. So partial equilibrium is the one which is based on only a restricted range of data, and also particularly on one market at a time. So example is like price of a single product is the prices of all the other products being fixed during the analysis. So like trying to understand price determinations for one particular commodity in one particular economy, that will be considered as partial equilibrium. So that is like dealing one commodity, one sector at a time, that is considered as kind of partial equilibrium. So say deals with each market independently, without considering the effects of changes of other markets, that will be considered as like partial equilibrium analysis, like analysis of particular sector or study of behavior of individual decision making. Like say here I have taken these two examples, like for students, like we need pen and we also need pencil. So here we are keeping the relationship between pen and pencil independent. So when we try to buy pen. So this is very standard, functional relationship between price and quantity. And here is basically on the downward sloping curve is the demand for, say, pencil, demand for pen here, and this is supply for pen here on, and we know that demand function is downward sloping and supply function is upward sloping, and here is the equilibrium, right? So in this point we'll get the optimum level of price, and here is optimum level of quantity for what, for pen. So here is for pen, and here also is basically for pen. We are trying to find out the optimum level of price and quantity. So in this particular case, like we are if we want to buy pen, so market for pen will be independent than market of, say, fruits, vegetables, or pencil, for instance. Although pen and pencil are very closely substitute, but then here we will only try to calculate what is the optimization or equilibrium price for the pen and equilibrium quantity or optimum level of quantity at the given market conditions, what should be the case. So this is like, and likewise here also, like, say, here supply curve for pencil, and here demand curve for pencil, and here likewise quantity, optimum level of quantity for pencil, and then here optimum level of price for the pencil. So here pen and pencil, although it will be dealt differently at the market, but then these two are independent. So this is one can call it like partial equilibrium, like analyzing one market or one product at a time. So now moving for the general equilibrium, and in the general equilibrium is here, like, general equilibrium approach is basically demand and supply of one market, like demand for pen or demand for pencil and supply of pen or supply of pencil of one market affect the other market. Like, for instance, if we want to understand, like if price of the pen increases, is there any demand for pencil, more demand for pencil? Or likewise, if demand for pencil increases, is there any less demand or more demand for pen? So then it is like changes of the price of one commodity, what is the demand or the price impact on the price on the other commodities. So this is two markets are actually impacting to each other. It's like one market is affecting others and vice versa. So that is very typical general equilibrium point of views. So general equilibrium looks at entire economy simultaneously, and that is a very real kind of situations. Like, it captures interlinkages between markets, of course. Like take the example of, say, coffee and tea. This is a classic example you will find in any of the standard books. Like, if price of the coffee goes up, whether is there any demand, more demand for tea. If that, then it is basically closely substitute goods. So different types of goods we'll discuss, because policy also depends on nature and the types of commodities or the goods, or say in the students that we have already discussed, like between study and going to watch a movie, or say the relationship between going to theater to watch a movie, or you're kind of watching movies through Netflix. So for instance, if what is the relationship if the price of the movie ticket goes up, and then is there any increase in demand or decrease in demand in watching movie in OTT platform like Netflix? And if that, then of course the consumer or as a whole it is basically a movie and then watching movie in the Netflix. These are being closely substitute to each other. So it is basically, you know, what is impacting on what, and what market, like, you know, movie theater, I mean movie market is impacting or affecting, I mean OTT market is affecting to movie theater, or if the different other behavior, like, you know, I'm not watching through Netflix, I want to get more visual impacts or effects in theater, and therefore I'm not subscribing Netflix and going to watch a movie in a once in a month in the movie theater. And then that means that is movie tickets, or the price of the movies are affecting OTT, you know, platforms, or watching movies in the Netflix. So that is actually, you know, two markets are actually interrelated, interlinked, and then output actually you know, depending to each other, is basically I can't watch both the movies. I can, but then I can't watch both the movies at the same time as a rational kind of human being, and therefore I'm choosing one over another, and therefore there is a substitution between two commodities. So now in the policy debate, it's like how a policy in one market affects other through prices, general prices of the commodities, and then wages is basically again price of the labor, different resources, or my consumption pattern. Here, like this is like real time data based sort of, you know, policy frame. If I want to understand the inflation rate, then I'll try to understand price of the commodities, and then its changes over time, and wages, what is, like, you know, impact on the wages on certain policies, or what kind of policies I need to take it to increase the wage rate, or say precisely if we want to increase the minimum wage, the policy that one can take. So as a policy maker, wage cannot be increased you know, infinitely, because if wage increases, then generally, you know, people will have more money, then they will go to the market, then there will be more demand, more money circulations, and that will lead to, as we know, that lead to inflationary situations. So therefore, even to, you know, increase the price level or increase the wage level, so we have to be very careful about, you know, from the policy perspective, how it should be you know, controlled, or what kind of policy should be framed. Likewise, even on the resources, there are so many acts, so many policies are there to control the resources, and also on the consumption levels, right? So now here I stop in this lecture, and then these two references I thought that, you know, it will be useful for you. One is Mankiw, which I already have told you, like the part of the principles of macroeconomics. You can actually consider some few of the selected chapters, and then Richard T. Freund's book, 10th edition, that macroeconomics theories and policies, will also be useful, especially in order to understand all the expenditure approach and income approach of calculating you know, output or the national income, and then breaking all the components of the total national income equations, like y equals to c plus I plus g plus x minus m. So if you want to understand each component of this, like consumption, investment, government expenditure, tax rates, and this will actually help you from Freund. That's what I thought, and I hope this is useful, and then we'll meet in our next class. Until then, thank you very much for your attention.